Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Unfortunately, this channel will not self-destruct in 5 seconds. This is just an excuse to put Inspector Gadget on the thumbnail. Clickbait. Thank you. Um, so sometimes people do like write comments like "velocity banking is a scam," and they get really passionate about it. Now, some of you might be thinking like, "Hey, do you get bothered by these comments that people are writing all this stuff?" And the answer to that is not really, because I've never had a time in my life where people actually agreeing with me or even disagreeing with me actually affected me achieving my goals and outcomes. So, why focus on something that doesn't help you achieve your goals and outcomes, right? In fact, what I'm going to do right now is I'll just admit in front of everybody who says velocity banking is a scam. Yeah, yeah. You know what? It is a scam. But even though I say it's a scam, guess what I'm looking at right now? A mortgage paid off under 3 years. Okay. And how do you know it's paid off under 3 years? Well, lien position one. 2051 is the maturity date, meaning the 30th last payment in the 30th year. You just subtract 30 years, it's 2021. July 29, 2024, principal balance is zero, total amount due is zero, and I paid it off. So if someone's going to go up to me and say it's a scam, I'm just like, yeah, cool, man. Rock on. I support your truth, right? Isn't that like the catchphrase nowadays? I support your truth. And now let's do this before we get started in our velocity banking review for today. I asked this last time, but this is just another excuse for me to flex. And I can't believe it's been 3 months since I paid off my mortgage in 2 years and 9 months. Wow. So let's ask ChatGPT this. Um, Hi, well, I don't know if I should say hi. I paid off my 30-year mortgage in 2 years and 9 months. What percentage of people does that put me in? Um, so let's just go ahead and do that. Folks, according to ChatGPT, I am the not even the 1%, under 1%. So you remember back in the day they had like the Wall Street protests. I can't forget. I forget what it's called. Yeah, Occupy Wall Street, and they're talking about like obsessing about like we're the 99%, and then like, the 1% are screwing us over. Well, I know we're in a different context, or we're talking about a different context, but I am not even the 1%, under 1%. Let's go ahead and play this.
Paying off a 30-year mortgage in under 3 years is an exceptional feat. Most homeowners follow the standard term or pay it off slightly early through extra payments, refinancing, or making incremental prepayments. Paying it off in less than 3 years would place you among a very small percentage, well under 1% of mortgage holders. This is because the average homeowner generally takes 15 to 30 years to fully pay off a mortgage, with fewer than 10% paying it off within 10 to 15 years through accelerated payments. The determination and financial strategy needed to achieve such a rapid payoff puts you in an elite category.
Thanks, ChatGPT. I'm elite. I am elite. Almost like a Yelp elite reviewer, but with mortgages, right? Okay, so let's get started. So, what is velocity banking? Apparently, people think it's a scam, and that's cool. Again, I support your truth. That's like the cool catchphrase nowadays. I think they say that in colleges a lot, but you probably won't learn this in college. So, velocity banking is a debt payoff strategy where you use your line of credit as your main operating account. And the whole premise of it is you're going to put your entire paycheck into debt and use your line of credit to help you get there. Okay. And so all we need to do is we need to do a budget. Okay. So you need to see this budget right here: income, expenses, leftover savings. And then we have all of these debts. So it's important to list every single debt that we have. And then you can see here that maybe we have a dual income household where one is a med school or doctor and one is a lawyer. I think that's common enough that it could be a common enough scenario where some people might be able to relate to this. And there's 13 grand of income. Okay, at least. I don't know. I just put in a round figure just to make it work. And then we have $12,000 of expenses and only $500 left over. So if you were making 13 grand a month and only had $500 left over, how would you feel? Right? And if you look at the statistics, only I think 50% of people who make over six figures are living paycheck to paycheck, right? And that also depends on what area you live in as well. So if I'm making six figures in, let's say, like rural Arkansas, that'd be so much better than six figures living in New York City, right? But yeah, so let's just keep going. So we need a budget, and then we need a line of credit as our main operating account. So, what is a line of credit? Well, if you have a line of credit, it might look like this on your smartphone. So, I have something called a home equity line of credit. So, what's a home equity line of credit? Well, basically, you can put your home equity as collateral to the bank, and the bank will, in return, offer you a product in the form of very similar to a credit card. So, a line of credit is basically a financial tool where you could borrow money, pay back, and then use it over and over again. So you get ultimate flexibility. And for borrowing that money, they charge you 8% annually, right? So 8% annually is, and if you want to know the daily rate, you just divide by 365, and that's the daily rate based on the average daily balance, if you know how to do the calculations. So as you can see here, I have a home equity line of credit, and the bank says in the screenshot that I could borrow up to $267,000, meaning I push a button, I can borrow that money, put it into my checking account, and then I can use it to pay whatever I want, right? Ultimate flexibility. That's the reason why we have the home equity line of credit as our main operating account so that we can move and shuffle some debts, dump all of our paycheck in, and then rinse and repeat the process over and over again. So, a credit card works as a line of credit as well because it is a revolving account. You can use it over and over again, but the only problem with credit cards is that you can't use it to pay whatever you want. So even with this home equity line of credit, I think I had a 30, no, was it an $80 bill? Yeah, I think I had an $80 bill due on my home equity line of credit. And you know what I did to pay it off? I just borrowed $80 from the home equity line of credit and put it back the same day. That's what I literally did to pay off the home equity line of credit bill. And so it's ultimate flexibility, although a credit card does have some advantages compared to the home equity line of credit, right? And I'm not going to go too much into this, but think about rewards points and all that. You don't get that in a home equity line of credit. And also, you don't get like grace periods in a home equity line of credit. The moment you pull out the money, that's when they charge you interest. So you might want to actually combine credit cards and home equity lines of credit. In fact, I have over $527,000 in lines of credit. $527,000. And I'm going to tell you, some people, this is a big issue where I got to tell you about how you have to brainwash yourself and understand the mindset um, of dealing with banks, right? Because what will happen with a lot of people is they'll get themselves into a crunch and then look at these videos and they're like, well, how do you get a line of credit when you're at this point in life? And the answer is you don't, or at least in my opinion, you don't. And even if you did, I wouldn't teach it to you that way because I still don't know. It's kind of like getting like insurance after you crash a car, but you didn't have it right before you crashed the car, right? Like I'm pretty sure there might be a way to get insurance afterwards, but if you didn't have any insurance before you crashed the car, it's really, really hard to get it, right? It's the same thing with the line of credit because, you know, banks don't lend money to people who need it. And this is very hard for people to understand. And why is this so hard for people to understand? It's because of bank marketing. Think about the terms that you hear in like bank marketing commercials, like we're here for you, we're part of the community, we support you. You realize like you hear that. So when people see these commercials and they internalize that message, they actually think the bank's actually there to save them, when the bank is actually a very cold, calculated risk management enterprise that loans money, right? There's a reason why every downtown, the tallest buildings there are owned by banks and also insurance companies because they're both in the risk game. And if you're in the risk game and you know how to play it well, you can make a lot of money, bigly. right? So let's just ask ChatGPT this before we actually get into the velocity banking payoff and all that. So I asked this before, but it's worth asking again because I talk about this a lot with people, and it's very hard for them to understand this because they understand the bank's point of view from their own marketing rather than the looking at it in reality, because the bank doesn't tell you the reality of how they actually operate, which is they don't lend money to people who need it. So I'll just ask this: why would the average person feel shocked and possibly offended to find out that banks don't lend money to people who need it?
Many people might feel shocked or even offended by the idea that banks don't lend to those who genuinely need money because it challenges the fundamental assumption that banks exist to help people access financial resources. The belief that banks are there to support individuals, particularly in times of need, is widespread and reinforced by bank marketing, which often promotes services like personal loans, mortgages, and business loans as accessible solutions to financial challenges. However, the reality is that banks operate as for profit entities that prioritize minimizing risk. They assess borrowers on their ability to repay, meaning they're more likely to lend to people who already demonstrate financial stability and have collateral, reliable income, or good credit scores. To someone who doesn't fully understand banking practices, learning this can feel like a betrayal or even discrimination against those who are financially vulnerable. This shift in perspective can be jarring and might provoke strong reactions, especially from those who've experienced financial hardship and believe that traditional banks were the best path to upward mobility. Realizing that banks tend to lend primarily to those who don't necessarily need the money can feel unfair and contrary to a sense of societal duty.
Right. And then let's just ask one more question. Doesn't their marketing contradict their actual business practices? Why would they do that? Why would they do that?
Yes, bank marketing often does seem to contradict actual banking practices. Ads tend to focus on themes of empowerment, support, and access, suggesting that banks are there to help people achieve their dreams, buy homes, start businesses, or get through tough times. This messaging can be misleading, given that banks prioritize lending to people who are financially stable and low risk, those who are likely to pay back the loan without issue. Banks use this kind of marketing because it builds public trust and broadens their appeal. Even though they cater primarily to lower risk clients, creating an image as people friendly institutions helps banks attract a larger customer base, including those who might not immediately qualify for loans. People with fewer resources still open accounts, use credit cards, and start small loans, which are all profitable for banks. Additionally, marketing that presents banks as community oriented or compassionate institutions helps counter negative perceptions and criticism that can arise from their strict lending standards and profit driven approach. Ultimately, it's a calculated strategy. By marketing to a wide range of people, banks secure more deposits, expand customer relationships, and increase the chances of developing clients who may eventually meet their lending criteria. This creates an ecosystem where banks maintain profitability while appearing accessible and supportive, even if the reality is more complex.
I think that this sentence is pretty deep, and I'll tell you why. I have this theory that more people rag on landlords than they do on banks because banks have a marketing arm to present themselves in a way that counters reality. And landlords don't have that, right? So I think that's why people are much more likely to really bash landlords much more easily than they will to a bank. Okay, so I think that's a really deep sentence right here. So, all right, so let's go back to here. So, my point is this: a bank won't give you a line of credit if you need money. And that's the sad truth and reality of it, and people refuse to accept it. And again, it's about understanding that you need to build your foundation, do it right before you ever get into debt. And so when I learned velocity banking, I actually made $20,000 a year. And I was like, why am I even learning this? And I studied it for just 2 or 3 years, kind of almost like me playing fantasy football with my bank finances, like I'm doing right now. And then now, once I kind of understood and internalized the game, that's how I was able to get the money because I knew that could only get it before I ever needed it. And that's how I got a $280,000 line of credit. So again, $527,000 in like credit lines in total. Me flexing right now. That's what I normally do, and so so if you want that much credit, and I'm probably going to get more in the future, you just get it when you don't need it, right? So you understand what the bank wants. So think of it like this, right? The bank is kind of like Dracula or a vampire, and they want people who are full of blood, right? If you need money, you're not full of blood, right? You realize that if you need money, you're not full of blood, so the vampire is not going to suck your blood or do business with you. Okay? Now, if you don't need money, that to a vampire, that's like, whoa, you got a lot of blood in you, right? We're ready. I'm ready to sink my teeth in. And then if the vampire is something you want, like a line of credit, and you're going to do business with it, well, once you do business, then you got to pull out the garlic and the sunshine and then kill it off as soon as possible. But when you present yourself to the bank, you got to present yourself full of blood, if that makes sense, right? Again, banks don't lend money to people who need it. I can't stress this enough. Like, I really can't. Like, too many people don't understand this, okay? I'm going to go over this over and over again because when people talk to me, like, I know they have the wrong mindset because they act like I need their money when I don't. This is why I love doing business with the bank because they know I don't need their money, therefore they're going to do business with me. But because most people have what I call a poor person mentality, they only think that people would want to do business with them because they need their money. Whereas people who are really smart know the opposite, that you only do business with people who don't need your money. Or it's a much more calculated risk to do it with people who don't need your money. Okay? All right, so let's just go ahead and do this. So we're going to assume two things: same income. So velocity banking is not making more income, but it is about not having savings, right? Savings, okay? So if you're like me and you take a look here, this is like one of my checking account statements where the beginning balance is zero and the ending balance is zero. So that's what we mean by zero savings because all of the money that we make is going to be put into debt. All of it. Okay. So let's go ahead and copy and paste these expenses. And then we're going to have something called cash flow, even though we have no savings at the end of the month. And if you want to know if you're in the matrix or not, just ask your friends who are probably broke. Hey, I haven't had any savings for about 3, 4, 5 years, and then they'll freak out even though they themselves don't have any savings because a lot of times people freak out if you just go against the norm. All right. Oops, excuse me. All right. So now we have something called cash flow here. And so what we're going to do is assume that we have a $300,000 home equity line of credit because we're a doctor, lawyer. Maybe we went nice on the cars, but we went modest on the house, right? Because they sometimes say the car is more valuable than the home because you got to drive to work, right? So you got to drive to work. So yeah, let me. So maybe you have a huge home equity line of credit like this. So maybe it's $300,000. I don't know, but you probably won't get it. So you gotta get it before you ever need it. And then the funny thing is, even if you ever get it before you need it, you probably would never even be in this situation in the first place, anyways. So it's like this life of credit is a huge lifeline. So let's assume that someone did give you this lifeline. What we do first is we move high interest rate debt, usually credit cards or those short term buy now, pay later loans, into the line of credit. And so let's figure out how much this is. So it's 15 plus 27 plus 10. And then this is $52,000. So this is what we can do. Move this $52,000 into that line of credit. And then guess what happens when we just move this $52,000 of credit cards into the line of credit? These all payments go to zero. And so now we're at $500 to $2,000 of cash flow. Okay. And so now the actual strategy is you put your entire paycheck into that line of credit and then expenses out. And then and you just repeat the process over and over again. So paycheck into line of credit, expenses out of line of credit, and then your cash flow will be used to reduce the balance. And this might take a while because $2,000 of cash flow on $52,000 of debt um, is not it's not the greatest cash flow, right? So, but let's just keep going. And so now let's just do this. So this is I1 or I2 plus, whoopsie, next month's I2 plus 1. Next month's balance is the previous month's balance plus the previous month's interest minus whatever our cash flow is. So 2206.29, right? And then what we're going to do is we're going to take the average daily balance, right? We take the average daily balance, multiply it by the interest rate, which is zero 0.8, no, 0.08, and then you divide by 12, right, to get the monthly interest. And then, so now let's just keep going at it, right? And so how long is it going to take to pay off these credit cards? And then you'll see that in about 2 years, uh, actually a little bit more than 2 years, we pay these credit cards off. So, all right, now we paid the credit cards off in about 26 months, right? So 26 months, and that's 52K, okay? 26 months, 52K. Now we have these auto loans, okay? And then we got the law school loan, med school loan, and mortgage. So now this is what we're going to do. Let's figure out what the balance of this is at the with our loan calculator. So what we do is put 26 months into this loan calculator. And then as you can see right here, we have something called the cash flow index. So think of it as a ranking system. So the lower the number, that's the one you want to put into the line of credit to recover your cash flow. So let's go ahead and move these two, right? So what's this plus this? So this is G2 plus G3. And then so it's 73 grand. So let's move 73 grand into that line of credit. And this is where things, I think, will really, really take off. Let's just see. So now, whoopsie. What do I do? Okay, so now let's move to 73 grand here. So 73, 089.17. Okay. And then now what's our cash flow? Well, now these two payments go to zero, right? And so our cash flow is 4 grand. Whoa, that's pretty good, right? So 4 grand. So let's go ahead and copy and paste. And then control value, Whoopsie, what am I doing? How did I make it blue? Oh no. Okay, great. So now let me copy and paste this. And then right here. And so now our cash flow is 4582.43. So now it's, instead of 2206, I erase this, 4582.43. Alright, so now let's go ahead and do this and see how long it takes us to pay those sweet, sweet 2 auto loans, right? And it takes us 43 months to pay our $55,000 and $65,000 cars. Alright, now we got that covered. And let's go ahead. Whoopsie. Oh, alright. So I'm not used to Microsoft Office on the web, but it's good to use this from time to time so that you know that you don't have to actually purchase Microsoft Excel to do these calculations because the web version is free. And the way that you know it's free is because it's asking you to buy. All right, so 43 months. So 43 months, this is all gone. And now it's 52 plus 55 plus 65. These are nice cars. Not gonna lie. I've never bought a car in my life, although I've bought property. Isn't that funny? All right, so now, okay, let's figure out at 43 months what the balance of the rest of the loans are, which is law school, med school, and mortgage. Again, dual income household. Um, so now let's go to the loan right here. And how much is 13 grand before tax? Now, I'm a little bit curious now, but I'm too lazy to look it up. So let's just see here, 43. So now this is 43, 43, 43, right? And so here's the thing. I notice this is an 8% loan, right? And so what I might do, because the line of credit is 8%, is I might transfer this whole 8% loan. And not only that, it has the lowest cash flow index out of all these loans. So let's go ahead and do that, 145 grand. Okay. So I know I'm going a little bit quick here, but this is now like the med school loan. Okay. Plus 145,768.66. All right. So now that we've done that, then we got $2,000 more of cash flow. And then this is now, oh, look at that, $7,000 of cash. So things are looking pretty good now. Moving on up to the east side. I don't think I've ever watched that show before, to be honest. So, all right, so now what we do is we put our cash flow as 7,008.98. Yep, okay. So now let's go ahead and see how long it takes to pay off that med school loan. Okay, and so now that's going to take 66 months. Sweet. All right. Where's that? Something's wrong because where's that thing supposed to be? Oh, there we go. See? I don't know how to make it appear. There we go. So 66 months we paid it off. So this is 66 months. And then it's 172K plus 200K of the med school loan. So now that's 372K. All right. And then now let's figure out 66 months what's the law school and what mortgage, how much the balance is. So these are all technically 0, 0, 0. Okay. And then what right now it's 66 months. So it's going to put month 66 right here, month 66 right here. And then this cash flow index is at 46. So if you know like the guidelines, they say it's safe to put anything below 50 in the line of credit, which we can do. So let's go ahead and do that. Put this 80 grand into the line of credit. 80 grand into the line of credit right here. And so now that's plus 80109.23. And now let's see how much cash flow we have. So this is going to now be 0, right? So we got 8 grand of cash flow. That's pretty sweet. 8 grand. Okay. So now what we do is we copy and paste this right here. And then we just replace our new cash flow with 8735.1. Is it 18 or 19? Do they round when they do these formulas? Let me just quickly check. 19. Okay, I'll do 19. All right. So let's go ahead and do this. And wow, 75 months. That's pretty good. 75 months. All right. So 75 months. It's gone, and then 172. No, 372 plus 150. How much is that? So goes 372 plus 150. That's going to be 522K paid off. And now it's the last one, which is the mortgage. Now, should we place our mortgage into that line of credit? And usually, if you have a very high CFI, cash flow index, what that means is that if you put the loan into the line of credit, you're not going to get that much cash flow back, right? You only get $1,200 of cash flow back for paying off the loan. So in this case, if we want to just kind of keep most of the benefits of velocity banking, you could do something called chunking, and the main benefit is in this case would be that yes, you're saving interest, but you're also not segregating your income. It's a very important concept to not to segregate your income. In fact, we had a live stream a while back, a couple of months. I don't even know, has it been a couple of months? Where somebody sent me their spreadsheet, their financials, and it had 22 debts. And why was that person struggling is because they were segregating their income. So even this is though this is our last loan, technically, we still don't want to segregate our income. So that's why we would still use a line of credit. And plus we'd be saving all the interest. And in addition, like last point, is that it's very easy to do. Extra payments directly to a loan ruins most people's cash flow, and this is why the bank knows that every 5 to 7 years they could send a letter to most people to refinance, because they know that people struggle with their cash flow. And they know that the bank knows that you'll never make an extra payment. Kind of like, how most gyms know that you're not going to go there in the New Year's. Like, they'll make it really cheap, but the reason why they make it really cheap is because they know you're not going to use the products. It's the same deal with term life insurance, right? Like, why do they make term life insurance so cheap? Is because they know you're not gonna use the product. Same thing with like extra payments to a loan. Nobody ever does it, and that's why they make the loan interest rates cheaper. Loan interest rates are determined by two things: the risk, the amount of risk you represent to a lender, and number two, the amount of access you can have to your money. So when a loan is a one-way street, much harder to overpay it, which is why most people do refinance. Okay, so enough of that. So luckily, I have a velocity banking calculator to represent chunking or chopping up your mortgage. So let me go ahead and open that up. Give me one moment. Okay, so I think I got the velocity banking calculator up and running. Just put in this information here. So take a look. I just put the original balance, current balance, all the loan details. The chunking amount is the amount that I'm actually moving to the line of credit, and usually at this stage it could just be a small amount comparable to your paycheck. And in fact, look at this. This is 30%. So it's like if you're using a 30% credit card, this is the results you're going to get. And actually, we're using an 8% line of credit. And so take a look at this. Like, oh my goodness, 38% or 30%. 30% just means $5,000 more of interest, but the time payoff, I think, is the same. Wow, this is really impressive. Now, here's the thing, and here's what's really not intuitive to most people. You shouldn't move a 3% mortgage into the line of credit because remember that high cash flow index over 200? You're not going to get enough cash flow to offset the interest for this. Okay, so what I mean by that, so let's say I move this entire balance here to here. You see how I actually pay like double the interest? And again, 25 grand isn't that much, but why pay more than you have to? 15 or yeah, 15 grand, I mean. So why pay more than you have to? So, if you want to um, just pay 15 grand to the bank because you're generous. I mean, you could just give it to me. Wink, wink. Anyways, so this is a velocity banking calculator provided by Renatus, and I'll just probably go over that in another time. But this isn't my calculator, and so, but yeah, I just put in details in 2.3 years, and it's pretty sweet, and I'm good, right? I'm good. 2.3 years. Oh my goodness. All right, so now 2.3 years it's gone. So now this is going to be zero. And then what is our actual cash flow? Now it's 10 grand a month. 10 grand a month. And let's actually write down how long it took us to do this. So this will be, um, I lost my train of thought. Oh, no, 2.3 years. So this is going to be 75 divided by 12 plus 2.3. And that's Was 8.55 years? That's wow. So 8.55 years, and how much debt did we pay off? So it's 522 plus 300. So that's $822,000 of debt, right? And I think what really saved us is, yeah, we over splurged on like these auto loans because these are probably like Mercedes, Lexuses, or BMWs, or the high class Toyotas. I don't really know because I've never bought a car before. But because we decided to go a little bit modest on the house with the lower interest rate, and actually let me put K here. K. So $822,000 of debt that's been paid off. Okay, in 8.55 years. If we had a more expensive home that I think a lot of doctors and lawyers like to purchase in maybe the 400 or $500,000 range, it could have probably taken us 10 to 11 years, right? So 8.55, not again, think about this. You know, have you ever seen those velocity banking videos where it's like you can pay off your mortgage in about 7 to 10 years? We actually did it in 2.3. The rest of the time, we're just focused on paying off all this other debt, especially the law and med school. But once we got to the mortgage, it only took us 2.3. Isn't that crazy? Oh man, this must be a total scam. But if you think this is a total scam, man, I totally agree with you because, well, people like me who kind of run these scams will just have these debts paid off pretty quickly. And then I'll just be staring at my cell phone with all the money that I have that the bank will lend to me because they know I don't need their money. So I'll be well off. I'll be fine. I'll be fine. Okay, so you know what? I'm now interested in watching a little bit of Inspector Gadget just because it's been such a long time. But yeah, sorry, this channel's not going to self-destruct in 5 seconds. But I will end the video in 5 seconds. So five, four, three, two, one. Have a great day, everybody. So, and we will speak next time. It's Creating Atlanta Mentorship.